Attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to TechGeek webinar series, our endeavor to impart techies. We believe that sharing of knowledge is the key to enhance our skills and grow us as professionals. With this principle in mind, we have initiated a series of webinars conducted by industry experts to give you all a crisp insight of various domains. The topic of today's session is Payment Systems Card Services, a preview. Our guest speaker today is Mr. Haresh Chetnani, General Manager, Business Analytics Center of Excellence, Pfizer India. Mr. Haresh has over 30 years of experience in financial services domain, primarily insurance. Having worked in almost all geographies, Haresh brings to board varied experiences on business domains that technology at Pfizer supports. So without further delay, I introduce you all to our guest speaker. Over to you, Mr. Haresh.
Good evening, everybody, and as always, it's a pleasure talking to this crowd. Let me introduce the topic. First of all, if you would have gone by the introduction, we said that nearly, payment is something which nobody, card service is something which nobody today is not aware of, is not actually gone through or is not touched by. So the whole idea is to make sure that we acquaint ourselves with the card services. The services, it's not just about cards. For us, it is very simple. We go to a point of sale place, swipe a card, but there's a whole universe which is behind this card systems. And in the first of many, I hope, series of these kind of sessions, I would like you to get yourself introduced to this card services. It's an overview, a lengthy one. I'm planning to cover a lot of data, a lot of stuff related to cards in terms of regulatory, in terms of interchange fees, in terms of concepts, and in terms of how the card services industry in India right now operates. So getting on to the main part, here it is. Card services are services that help financial institutions, which is acquirers and card issuers, and enable them to process card payments through various payment channels. Now, the payment channels could be varied. It could be an ATM. It could be a point of sale swipe. It could be the usage of a card through an online banking transaction. So there could be various channels. We'll be talking about key players. There would be the issuers of the cards, the acquirers, the processors, and the networks. Okay, moving on. Typically, this is how a card transaction takes place in the background. Your card issuers would be your banks. Your card holders would be ideally you. The merchant is the point of sale. You can see an ATM over there, so it could be an ATM or a merchant. The acquirers are many organizations who help acquire the business for cards. There are these are outsourced companies. And of course, the card association network, which would typically have the Visa, Master card. Let us also understand how there are two major activities that take place. First of all, once the card is swiped, you have the authorization and authentication activity that happens. Now, the authorization and authentication could be of two types. The one level of authorization and authentication is by the card issuing network, so which it could be possibly Visa or MasterCard, who would and the bank who would first determine whether the card is genuine, no fraudulent transaction is taking place, the credit limits are in place, or in case of a debit card, the bank has got sufficient money. The card name, the card number, the card acquirer, all those details are first checked. The other level of authentication that would take place would be at the bank level, which would be typically, can I dispense this cash today from the ATM? Is there that much cash available? Is there the credit limit available, and things like that. And finally, the second level of activity that happens is the settlement and reconciliation of the transaction that has taken place. So that would typically happen at the card association network. It's the Visas and the MasterCard who would combine all the payments, reconcile, and would pay the merchant, at the same time pay the banks and debit the banks, debit the personal accounts of the card holders in the banks. A brief history, cards might be new to India. They started only in 1980. But if you come to think of it, it's since 1914 that the first card was ever developed as a metal card, right down to 1977, where where Visa, earlier known as Bank America, AmeriCard, came into being. So, and there is considerable history after that, but I just wanted to, in the interest of time, limit myself to only having the first day when the cards were issued in India, which was in 1980, and Central Bank issued the first card called Central Bank Card. Now, as I said, we are talking about the landscape, we are talking about the horizon of card services. So when you look at the horizon of card services, there's a debit card, there's a credit card, and which we are familiar with. Then there's a prepaid card. So you'll have your petro cards, which are prepaid. Your forex cards. Many of you who travel would have their prepaid forex card charged. So those are some of the prepaid cards. Where else is the card used? You cannot fathom, or you cannot imagine an ATM without a card. So that's where ATM cards are there. There are merchant solutions, there are network solutions, and there are support services as a part of the card services. As we go along down the line, we'll talk about how much do cards impact our lives, how much of revenue generation does the cards industry indulge into, how much of employment generation does the card indulge into. So that's why my focus is on the entire landscape of cards. So let's move on and see each one of them. So there are card solutions. What all does a card solution do? We talk about transaction authorization and switching services. We are talking about clearing and settlement services. We are talking about card management services, loyalty and reward solution. All these are a gamut of solutions that are available from the card itself. Then there is when we talk about transaction authorization and switching services, so there will be, I spoke about in the earlier slide, we talked about authorization of cards. We talked about switching services. So you could have multiple POS of multiple banks which are with the merchants, and those services are something that the cards provide for. Clearing and settlement services we discussed are out there to provide for settlement of settlement to the merchants and the banks and the debits to this thing. There are card management services, card issuing services, loyalty and reward solutions that we have spoken about already in the card. Just 1 minute. Okay, coming down to ATM solutions, there is this, while it is a very simplistic thing for us to go to an ATM and withdraw cash or maybe change our PIN or deposit a check, but there is a whole range of services that are a part of ATM solutions. So there is ATM device driving and monitoring. There will be ATM operational outsource solution. So there will be ATM deposit solution. There's a cash management solution. I mean, the cash in the ATMs has to be optimized, and there are specialist organizations. There are security organizations that dispense cash or deposit cash into the ATMs. Look at the merchant solutions. There's a transaction acquisition that the merchant does. There's a merchant account management that clearing and settlement again is a merchant activity. Plus the POS, point of sale, terminal driving, and support services. Again, as I said, we can extend our reach for the card services and look at network solution. There's electronic fund transfer network, the POS network, the credit card networks, and the payment gateways. From a support services, there is cash risk management, there is risk management, fraud management, credit bureau access, IT services, and of course the 24/7 call center services. What does the market say about cards? How has it impacted the general economy? Greater usage of electronic payments has added $983 billion in global economic growth between 2008 and 2012. We talked about the breadth of card services. Growth in GDP equivalent is almost equivalent to creating 1.9 million jobs. The numbers out here: electronic payments contributed to 0.8 increase in GDP in emerging markets and 0.3 increase in GDP in developed markets. Cards have card growth boosts recovery. So global real GDP was only 1.8% in between 2008 and 2012. Now, what kind of benefits do card services accrue to merchants and consumers? Essentially, it provides access to financial resources. Cards enable e-commerce and travel and tourism. This has become very easy nowadays. I mean, your e-commerce, travel, and tourism are today possible, growing mainly because of the card services that are in place. And primarily, the card services we are talking about are the global card services. They might have networks in India, they might be US-based networks, but we are talking about Visa, Master, which are global networks. Access to credit helps calibrate periodic income with continuous consumption. We've seen a 45-day credit available on our card, whereas wage earners or salary earners have got only limited income and income coming in a very steady flow. So access to credit helps calibrate periodic income with continuous consumption. So you can continue to buy stuff during the month, although you get to salary once a month, yet it gives you the leeway to go ahead and make your purchases. Trust in card transaction further drives consumption. So now the trust that the cards transactions have developed is only driving consumption further. So you know that at the end of the month, this is the date when your card gets charged, and this is the day when you have to make your payment. And so far as that trust remains, it ensures that the consumer goes and purchases, makes the consumption based on the parameters set by the cards. The peace of mind that merchants have with guaranteed payments also extend to consumers. So the credit is available, yet there is a guarantee of repayment. Cards provide convenience. There is no need to visit an ATM for obtaining cash. You don't need to carry cash in sacks for buying expensive items like your jewelry or diamonds and things like that. No need to count out cash at the point of transaction. So there is this added benefit of large sums of money not being carried in cash. These are the benefits to merchants. What about the economy? The economy talks primarily of higher potential tax revenue. This is because if you look at the second last bullet, there is a reduction in the grey economy due to lower unreported cash transactions. They will not be, the cash transactions have diminished from what they were once upon a time. Cash handling costs have reduced. Cost of printing paper currency has reduced. So these are some of the advantages. Guaranteed payment for merchants. Merchants are that much more confident that the payments will be received. Cards leave more funds flowing through the economy. Now, if everything was to be barter and cash, obviously the economy would not be as smooth as flowing as smooth as it does today, because the cards today has at a lowest denominator level made credit available and made the funds flow in the economy. As I said earlier, cards reduce central bank costs in providing currency, and of course, typical to Indian thing, the reduction in grey economy due to lower unreported cash transactions. So the cash transactions are all reported. There'll hardly be any unreported cash, thereby killing the chances of the great economic flourishing. Looking at what does future hold for these services. The future in terms of the merchant acquirers and banks and IT or service providers, the focus has increased considerably on consolidation of processing platforms and processing infrastructure across geographies. There was American Express once was limited to US only, and similarly Barclays was limited to UK. Today there is increased consolidation whereby a card is today can be swiped anywhere else in the world. So that thereby the focus is to consolidate the processing platforms and make it available across geographies. Increased focus on delivering value-added service to merchants and banks, so you have the reward points, you have more MDR as they call it, merchant discounted rate going lower because of the value-added services to merchants. Increased focus on fraud detection and prevention to minimize merchant losses. This is one big ticket area, although it is showing up third on this slide. This is one big ticket area that today organizations or the players in the stakeholders in the card services market are looking at. They are trying to minimize fraud detection, get into pin-based card services so that merchant losses are minimized, frauds are easily detected. Talking about focus on consolidation, large banks have either outsourced or disposed of their non-core acquiring businesses to card processors. So there is this whole universe of outsourced activity that the card processors do for the banks. The increased cost sensitivity of large issuers and acquirers has squeezed margins for card processors. Because of the scale that is now available to the large issuers and acquirers, this has squeezed the margins for card processors. Card processors targeting improved profitability by building greater scale and decreasing the cost of operation. The higher the number of cards, the bigger the scale and lower the scale of operation. So that is what consolidation is going to do to cards. A major component of this card services is an interchange fee. What is typically an interchange fee? We all think that what comes to us by way of card services is free, and there is this universe which operates on its own. But sadly, it is not like that. There is everybody's out there to make money. It is a very flourishing business, and the way people make money is through interchange fee. And now, what is interchange fee? It typically involves a payment from a merchant's bank to a card issuer's bank for each debit or credit card transaction. They are determined at the network level and are generally the same for all banks participating in the network. Card issuing banks often use a portion of their interchange fee revenue to encourage card use by offering their cardholders rewards such as cash rebates or airline miles that increase with card use. An interchange fee could be a percentage of the transaction or a flat fee per transaction. Okay, or sometimes it's a percentage of the purchase price also, or a combination of the two. Now this is where the problem is. Interchange fee rates together with growth in the volume have led to a dramatic rise in the interchange fee payments and consequently in merchants' cost of accepting payment cards. This is, as I said, a major sore point with this industry, and everybody is trying to work towards reducing this, as the merchants, although they find the convenience, they also see erosion of their own profit margins by virtue of this interchange fee that they have to pay. Now, this is a concerns by the various stakeholders. So look at what the merchants feel. Major card networks are able to set excessively high interchange fees, which leads to correspondingly high merchant fees. Now, who eventually benefits or loses in this bargain? The end user would typically lose, because the merchant has to pay the card fees to the networks, and he would pass on that cost to the consumer. Now, does it mean that the cash consumer gains in this? He would also not gain, because the price range would still remain the same. So that is one of the concerns of the merchants, and if they have to provide better services, if they have to provide cost beneficial products, then they will have to make sure that the networks who charge these interchange fees keep them at a minimum, so that their profit margins also show a little healthy. At the same time, the card networks say that the payment cards provide substantial value to both consumers and merchants, and interchange fees are essential for the proper operation of the card networks. Today, sitting in having an American Express card or a Visa card or a MasterCard, you can roam the world around, go to do duty-free shopping, and it is just one swipe that happens across multiple geographies. You don't feel the pinch, and that's what the card networks come up with the argument that there is this interchange fee which is making this world of card services move so smoothly, because and they are able to provide those network services across the globe because of the interchange fee that they charge. Coming down to the next issue that the merchant has is a common interchange fee serves as a means for otherwise competing banks to collude on their fees for card transactions and to avoid negotiation of fees with merchants. The interchange fee varies from bank to bank. That is one reason why competing banks would collude. I mean, no, we don't even know, but whenever your bank upgrades your card from gold to platinum, and from platinum to whatever, silver to gold, and gold to platinum, there is a different interchange fee that the bank is going to charge the merchant, and that's why that is where the issue is. The card networks feel that the common interchange fee standardizes the terms of exchange between the merchant's bank and the card user's bank. Again, merchants have the issue of restrictive network rules. So there is an agreement between the merchant and the card issuer and the networks that all cards will be accepted, and there is no such thing as cards not being handled, and no surcharge will have to be paid. So, which does not give a freedom of choice to the networks, to the merchants, to accept or reject a particular card. And the argument against that for the card networks is the resulting fees attempt to balance the two sides of the payment card market to maximize the value of the network. So, whereas a merchant might be losing, but at the same time, from an overall card services standpoint, if the industry has to gain, then merchants might have to sacrifice this additional price. Now, what would typically constitute an efficient interchange fee mechanism? There have been arguments back and forth, but there are three essential things that signify what an efficient interchange fee mechanism could be. The first one is an efficient interchange fee transfers surplus, that is cost and benefit, from one side of the market to the other in order to internalize the external effect that one party has on the other. So the merchant might gain by increased sales, and at the same time might lose on the high interchange fee that he pays. But then they say it's an effort which is a compensating effect over the overall market. In order to provide appropriate incentives to parties in a transaction, an efficient interchange fee may yield prices for card services to each side of the market that are unbalanced, in the sense that one side pays a higher price than the other. So it's a fact of life. One side will have to pay this. We'll have to live with the unbalanced thing. And the efficient interchange fee for a particular card network is difficult to determine empirically. So there are tangible and intangible benefits that each of the stakeholders have here, and thereby it is empirically not possible to determine empirically whether the interchange fee is efficient or not. So what is the need of the hour? Need of the hour is clarifying or eliminating restrictions on differential retail pricing across payment methods, prohibiting network determination of interchange fees. There is from an India standpoint, there is one study which says that RBI should intervene and put a clamp on the interchange fee instead of the networks or the markets deciding on the interchange fee. Regulating the level of interchange fees, relaxing card acceptance requirements. Right now it is accept all cards. That is one thing which the merchants are asking for, that they should be selectively be able to not reject but not accept some of the cards that they think are charging them higher interchange fee. And mandating multi-bug cards that can perform transactions on multiple networks with merchant control of networking routing rules. So if the unless the merchant have some control over the network routing rules, the multi-bug cards are likely to become a drain, and that needs to be controlled. That's one of the reasons they feel that that could help in reducing the issues that currently merchants and the networks face in terms of interchange fees. Banking, as you all know, is one of the most highly regulated industries in the world, and cards, by virtue of the nature of the business, has its own share of regulations that have been there all over the world. So way back in 1984, in US itself, the difference everywhere is that in the United States, concerns about interchange fees and rules imposed on the merchants by the card networks have been addressed mainly through private litigation. So federal agencies have never interfered into the imposition or the quantification of the interchange fee issue that the merchants and bankers have got today. Merchants and networks have got today. It's always through a private litigation. It was the lawsuit between Visa and the acquiring merchants, where the courts decided in favor of Visa in '94, stating that interchange fees were a legitimate mechanism of transfer cost from the side of the market that the court determined to have lower cost to the side with the higher cost. US Department of Justice versus Visa and MasterCard, the courts decided that no credit card issuer may be prohibited by any payment network from issuing cards on competing networks. So, for example, Visa and Master had a no-compete clause with the merchant acquirers, which prevented the Diners Club, likes of Diners Club, American Express, and Discover to get in, but that too was quashed by this ruling of US Department of Justice versus Visa and MasterCard litigation. In Australia, the government has established a payment system boards. Now look at this. This is where the difference is. Except for US, everywhere else you will find that the federal authorities have stepped in to provide competition, efficiency, and stability to the card services systems. Insofar as other countries are concerned, in a large and growing number of countries, authorities have taken steps aimed at reducing or eliminating common interchange fees. In several countries like New Zealand, Poland, and United Kingdom, competition authorities have determined that multilateral setting of interchange fees is illegal and must be discontinued. So, regulatory authorities are stepping in to regulate this interchange fee issue that is become perennially an issue between the merchant bankers and the networks. In Spain, the competition authority denied the legally required authorization of the payment card schemes interchange fee agreements and instructed the schemes to submit new plans for authorization. In other cases, either the competition authority or the central bank has reached an agreement with the card issuers to reduce interchange fees. No surcharge rules have been examined in a number of countries and have been implemented in the Netherlands, Sweden, and the United Kingdom. As we go along, I mean, I'm almost through with the global scenario as far as the cards are concerned. But as we go along, we see more and more interference coming from the federal authorities, except for US, where interchange fee is being today discussed. Now, how does it happen in India? In India, there's a National Payment Corporation of India established in December 2008. This has been set up by Indian Banks Association under the mandate from Reserve Bank of India. And the objective is to build a national level central infrastructure. coverage of which covers various retail payment systems. Again, as I said, retail payment system are not necessarily cards alone, but it could be online payment system, it could be others. Provide robust payment solutions to bank and financial institutions across India. Now it is, again, as I said, directed by federal authorities, so it is governed by the provisions of Payment and Settlement Systems Act of 2007. What does National Payment Corporation of India do? It has built a switch with wide range of services such as UID compatibility, mobile-based transaction, and POS transaction. India Pay Mobile Payment Services is another initiative of NPCI. Check truncation system being operationalized now at Chennai. National ATM and POS network, India Pay cards, and ACH is another activity that NPCI does. Okay, extrapolating what is happening globally into the Indian scenario. Okay, what are the drawbacks of the current system in India? First of all, as always, oblique pricing structure that treats and prices the credit and debit card in a similar manner has several drawbacks that hinder its growth and popularity. Okay, merchants are happy, and if you come to think of it, 0.1% of people having cards use their debit cards, as against 1.3% of the people having credit cards use a credit card. So typically it is the people wanting this extra credit, who are wanting this extra credit, who are more prone to using the credit cards. Thereby, despite the cash being made available through debit cards, the debit cards usage has been minimal. Now, some features of the product even cause potential risk to the user. Come to think of it, if you pay only the minimum charge for the month and do not pay the balance, do not pay the complete balance, the interest that is being charged to you is also not only on the unpaid balance of your previous month's credit card, but also on all additional purchases you make till you pay your next outstanding amount of the credit card. So now some of these hidden things are making making usage of these cards into a potential risk for the users. Debit cards are heavily underutilized. And there is this lower acceptability of cards by merchants. Once upon a time that was the case, but now when you talk of smaller merchants, yes, they do not accept cards. Again, gray market flourishes, cost of currency management is increasing. Even today, there's a lot that people are happy paying for cash. Lack of accountability. I mean, even today, accountability from the merchant side or the acquirer side also, cards are being issued without proper credit checks, without proper checks in terms of authenticity of the person to whom the card is issued, especially by banks who do not have who issue cards for the sake of issuing cards, as against issuing cards to their account holders. Potential of fraud in India. Our systems are yet to develop to a point where we can prevent, we can convert it into a foolproof system. Foolproof system does not exist anywhere, but yet in India there is a risk is relatively higher. Now, there's a need for RBI. What do you think could possibly lead to redressal of all the drawbacks that we saw in the previous slide? One of the thoughts that come to mind is there is a need for RBI to subsidize switch charges to promote cashless payments. There is a high cost to cash management. There is a high cost of printing currency, and there it makes a doesn't call for too much of wisdom that cashless transactions are much more efficient in terms of dealing with it. So there's a time has come when RBI should subsidize switch charges to promote cashless payments. Given the cost and risk involved in handling cash, banks need to favorably price electronic products, and a situation where electronic products are costlier than paper products should not arise. Now today, if you pay 40% on if you default on your credit card thing, your electronic charge is far higher than your cash charge. So the idea is to make sure that the electronic products are not too high priced, so that people get more and more encouraged to use the cards. The interchange fee on credit cards should therefore be left to the issuer banks, and competition should dictate the pricing in consonance with RBI general policy on non-priority sector personal loans. Look at, come to think of it, the credit card actually is a personal loan in one form. So you have 10 credit cards, and each one of them having a credit limit of 3 lakhs each. You end up having actually a personal loan of 30 lakhs. So in consonance with RBI's general policy on non-priority sector personal loans, it is the one of the recommendations is that the interchange fee on credit card should be left to the issuer banks and the competition to dictate the pricing. In order to provide convenience to both merchants and cardholders, cash withdrawal at point of sale should be clubbed along with purchase, so as to reduce cost and increasing efficiency in cash handling. Today this is happening everywhere else, except I have the countries that I have been to, I have seen this happen. But in India, we haven't come to a point where cash withdrawal at the POS is allowed. So that is one of the other. So if you want cash, at the same time you want to buy something, you will have to make 2 transactions. That is, 1, go to the ATM, collect cash, and 2, at the POS, use your debit card or a credit card. So now the same thing could have been done through one single transaction. Now this is interesting. An appropriate tax rebate can be extended to a merchant if at least 50% value of his transactions are through cards. Now this is actually in consonance with the very first bullet on the same slide, that there is a need for RBI to subsidize switch charges to promote cashless payments. The government should minimize, if not eliminate, the duties and taxes on manufacture and sale of EDC machines to promote its acceptability. Why I have kept this as the last bullet is because, as I said, we are talking about card services as a larger horizon, larger landscape, the canvas of card services. So if card services has to be efficient, and if the government has to step in, then an appropriate tax rebate can be extended to a merchant if at least 50% value of his transactions are through cards. The government should minimize, if not eliminate, the duties and taxes on manufacture and sale of EDC machines to promote its acceptability. I am done with my presentation, and I welcome your questions.
I've assigned you a few questions, Mr. Harish. Are you able to see them?
Yes, 1 minute. Yes, I can see them.
And continue with answering the questions now.
Yeah, I'll do that. Yeah. Okay, one question I have is, why do merchants charge the exchange fee to end consumers in India, even if there is an agreement between the merchant and the card issuer to the bank? This is not a common happening. This is something which, if the charges are high, as I said, we just talked about interchange fees, which in some cases the merchant and acquirers find the networks charging them too high. So to minimize the drain on their own finances, they tend to charge certain exchange fee. Otherwise, okay. There is another question I have here is how cards ensure greater financial inclusion. Come to think of it, okay, the financial inclusion that we are talking about is today. Let me go to the slide, and maybe I can then answer your question. we are talking about, you look at the earlier bullets on the same slide, it talks about higher potential tax revenue, we are talking about lower cash handling cost, it talks about guaranteed payment for merchants, it talks about cars leaving more funds flowing into the economy. And a reduction in grey economy. All this is actually generating a lot of cash within the economy, so that the last person standing could benefit from the from the revenues that are now available for. I mean, the smallest of person out there would today not have a debit card or credit. Some many don't have in bank accounts. Okay, so for them to be a part of this entire cards ecosystem, it is financial inclusion and be a part of this thing, financial inclusion. There is a need. We think that cards are one of the major reasons why they should be there. The other card is, can the government or RBI come into picture and reduce it, if not abolish the exchange fee? Yes, certainly government can come in, as we've seen, it's already happened. Actually, some of the recommendations that I have shown, have put in out there, are out of a study that RBI themselves have initiated on what can be done in terms of interchange fee. Private players are already doing it, and as I kept emphasizing during my conversation, that it is except for US, where these matters are settled only through private litigation, everywhere else in the world, be it Australia, be it Mexico, be it UK, it is the federal authorities that have stepped in to make sure that the interchange fees are regularized. How is it possible to withdraw cash and make payment in one transaction from POS? Today it is not possible in India, but if you go to Walmart and if you go to Elders and if you go to Sainsbury's of the world, you will always be able to withdraw cash through a single swipe. So it might today RBI restricts it, but I have seen it happen, and I have been a party to these kind of transactions also. Some other questions that are coming is how banks and card networks are able to offer 45 plus days. This is a long-winded answer. Maybe I can mail it to you later. Oh, there's another question which says, how come cashback of as high as 5% is can be provided? This again, as I said, it is all a part of this interchange fee thing where banks as a part of business acquisition announce these rewards and are able to manage it through either escalated cost of goods or escalated interchange fee. Well, that's all there was as far as questions are concerned. If there are, I see a few questions which will have a long-winded answer. So I would rather prefer sending those answers. You can mail me at haresh.chetnani@fiserv.com and I would respond to those questions.
Well, thanks Mr. Haresh for answering the queries of our attendees. Thank you so much for the insightful presentation as well. It was a great session.
Thank you. Thank you very much for the opportunity. Thank you very much.
I would also like to thank all our participants for the support in making this webinar a success. The recording of this session would be available on techgeek.com by today evening. Thank you all. Have a great day.
Bye-bye.